Over the past few decades, it has been getting increasingly more difficult for the average American to get by. While the median hourly wage has only increased by 186% since 1980, the median rent has increased over 390%, the median home price has increased 890%, and the median public college tuition cost has increased over 1100%. In today's video, I will be covering 3 institutions that have contributed to the declining financial health of American workers. Blackstone Incorporated. In the aftermath of the 2008 housing crisis, the Federal Reserve reduced interest rates to 0% and increased the money supply through quantitative easing to boost the struggling economy. As a result, traditional investments were yielding lackluster returns, and Wall Street firms began searching for new opportunities. Blackstone, one of the world's largest investment firms, believed in the adage that a good crisis should never go to waste. They identified 2 trends caused by the crisis that could potentially increase their profits. Housing prices were cheap due to millions of Americans foreclosing on their homes, and those same millions of Americans now had poor credit, which forced them to become renters. To capitalize on this demise of the American dream, Blackstone invested billions of dollars to buy foreclosed homes and convert them into rental properties through their subsidiary company, Invitation Homes. Specifically, in 2012, when the housing market hit rock bottom, Blackstone seized the opportunity to purchase 24,000 single-family homes and transform them into rental properties. Thus, a new corporate giant emerged from the ruins of the traditional single-family home market, the Mega Landlord. This Mega Landlord business created by Blackstone continued gobbling up single-family homes with low interest rate debt, and today they own over 80,000 single-family homes that are being rented out. In total, Mega Landlords now own 700,000 single-family rentals in America, according to research done by MetLife Investment Management. However, MetLife forecasts that by 2030, these Mega Landlords will own 7.6 million single-family rentals. This would mean that nearly 10% of all single-family homes in America would be rental properties controlled by mega landlords. In addition to profiting off rent collecting, it is rumored that these mega landlords would eventually want their properties to be outfitted with smart home technology to harvest valuable data about their tenants and further increase their profits. Currently, a significant portion of Americans, 35% to be exact, rent their households, primarily in the form of apartments. The stability of home ownership has been a driving force behind the growth of the middle class, enabling families to accumulate wealth and achieve financial security over time. However, as mega landlords continue to pour hundreds of billions of dollars into the single-family housing market, the likelihood of average individuals being able to compete with them and purchase homes continues to decrease. Therefore, the future appears to be a majority of Americans as renters, something not seen since the Great Depression. The Federal Reserve. Many economists believe that the Federal Reserve's low interest rate policies over the past few decades have contributed significantly to the lackluster growth of wages relative to living expenses.
If you look at what the Fed did, the radical gamble they took to get inflation up 30 basis points from 1.7 to 2, it's to me sort of a risk-reward bet. You bet one to lose 40, and they lost. And who really lost? Poor people in the United States ravaged by inflation, the middle class, and my guess is the U.S. economy for years to come.
The Federal Reserve claims that it kept rates low to encourage businesses to take out low interest rate loans to expand their operations and create new jobs. However, many large corporations took advantage of the low interest rate loans to engage in share buybacks and pay shareholders dividends. As a result, American corporations have spent over $10 trillion on share buybacks since the turn of the century. While this practice can boost stock prices and enrich shareholders in the short term, it does not necessarily lead to long-term economic growth or job creation. While the Federal Reserve has played a significant role in declining wages and a shrinking middle class, it is important to note that many other factors have contributed to the growing economic divide. For example, deunionization and globalization have also played a role in exacerbating economic inequality in the United States. Low interest rates have also contributed to the significant growth of the national debt, which has surged from $5 trillion in 2000 to over $30 trillion today. To repay this debt, raising taxes on wage earners in the future may be required, which could further worsen their financial circumstances.
I'm going to raise some taxes.
the Communist Chinese Party. China's rise as a global economic power has negatively affected the financial health of American workers in various ways, with increased competition being a significant factor, particularly in manufacturing. American companies have been taking advantage of lower labor costs and weak labor rights in China. There have also been reports of forced labor in industries like cotton production and electronics manufacturing. The state-led economic system in China often favors domestic companies over foreign ones, making it challenging for American companies to compete. China prevents foreign companies from competing in certain industries, even though they compete aggressively in those industries in other countries. For instance, while Chinese-owned platforms like TikTok can operate in the United States, American-owned platforms like Facebook are barred from operating in China. Moreover, had China been more transparent about the coronavirus outbreak, it could have resulted in a more effective global response to the pandemic, averting significant inflation that is presently burdening the American middle class. And if the Wuhan Institute of Virology had been more careful, it is possible that the pandemic could have been prevented entirely. Subscribe for more videos on infamous people in business and finance. Check out my last video on the top 5 largest stock market frauds.